Price moves all week, but it never gives comfort. The week forms inside stacked memory. Now we review the full week, not as a recap, as live execution. You are not watching after the fact. You are inside the trade. You see price reach the boundary. You feel the pause. You decide. Long, short, stop, target. No prediction, only structure. We begin with the 1-hour chart. Monday first, then Tuesday, then Wednesday, then Thursday, then Friday. Each day gives a different fight. Some moves look strong, then they fail. Some drops look dangerous, then they return. Some breakouts look clean. Then price freezes. That is where most traders lose control. They enter late. They move the stop. They wait for more. Then the market returns. So we do not follow the candle. We follow the session. Asia session. US session. Session high. Session midpoint. Session low. Each box gives a decision line. The line does not predict. The line asks one question. Can price stay there? If price stays, the trade survives. If price cannot stay, it returns. If reaction comes faster, continuation fails earlier. If distance becomes shorter, movement stays inside. That is how the week must be read. First, we trade the 1-hour structure. We watch the live battle. Then we step back. Daily chart, weekly chart, monthly chart. When the larger time frame appears, the 1-hour chart becomes clearer. You see why price stalled. You see why a breakout could not continue. You see why a late entry had no space left. You see why a move can look like reversal but still remain trapped. That matters for next week. Because next week does not start from empty space. It starts from the memory left by this week. So do not rush. Watch where the next session forms. Watch whether it forms inside the same daily range. Watch whether it forms below the 0.5 area. Watch whether it reaches the monthly lower box. Watch whether it can stay above the weekly compression zone. If it cannot stay, it returns. If it returns faster, the move weakens. If it holds, then the next trade forms. Now we enter the week. Price moves up, but it cannot leave cleanly. The session forms inside old memory. April 19th Asia session forms inside the midpoint of April 16th US session box. It does not form wide. It forms half compressed. The box becomes thin. The distance becomes small. Every reaction matters more. April 19th Asia session also overlaps with April 15th US session box. That overlap matters. Price is not starting from empty space. Price is starting inside memory. April 16th US midpoint and April 15th US box hold the same area. So when price begins to move, it is not just moving up. It is trying to escape from stacked structure. The first move lifts, but it does not run. It reaches the upper side of the April 19th Asia session box. It pauses. Buying tries to continue, but distance stays short. The move holds, then slows. If price is strong, it leaves the box quickly. Here, it stays close. That delay matters. It tells you the market still remembers the range. Price moves again. It reaches the April 16th US session upper boundary. It touches. It reacts. It cannot travel far right away. You do not chase the break. You watch the reaction. If price breaks, but returns too fast, the break fails. If price breaks and holds above the box, the long stays alive. Here, price holds enough. It does not collapse back. into the April 19th Asia lower side. The pullback comes, but it does not destroy the structure. That gives you the trade. The long is not taken because the candle is green. The long is taken because price reaches the midpoint, holds the compressed box, and refuses to return below it. April 19th Asia session gives the execution. Long entry line. April 19th Asia session midpoint. Stop loss line. April 19th Asia session lower boundary. Take profit line. April 14th US session upper boundary. Risk-reward ratio, 4.42. Now the reason matters. The April 19th Asia midpoint is not random. Price forms there. Price compresses there. Price keeps returning there, without breaking down. When the midpoint holds, the lower boundary becomes the failure line. If price falls below the April 19th Asia lower boundary, the holding attempt is gone. No holding. No long. No reason to stay. The target is not hope. The target is April 14th US session upper boundary, because price already pointed toward that memory. After April 16th US upper boundary is tested, the next visible pressure sits higher. April 14th US upper boundary becomes the place where the move must prove itself. Price moves toward it, but the path is not clean. It pushes. It slows. It pulls back. You are in the trade, but you cannot relax, because compression makes everything sharper. When the box is half compressed, the stop distance can feel attractive. Small stop, big target, good ratio. But that is also where traders get trapped. Thin structure creates thin stops. Thin stops get touched before the real move begins. The April 19th Asia session box is compressed inside the April 16th US midpoint. That makes the lower boundary usable, but still tight. In my actual execution, the stop sits at the April 19th Asia session lower boundary. That is the planned structure. But for viewers applying this method, a safer stop can sit deeper. The safer stop is April 16th US session lower boundary. Why? Because April 19th Asia session is compressed inside April 16th US session memory. If price dips below April 19th Asia lower boundary, it may still remain inside April 16th US session structure. That move can touch a tight stop, then return upward again. You are right about direction, but wrong about depth. That hurts. The trade works, but you are no longer in it. So the stop must match the structure being used. If you trade only the April 19th Asia box, the April 19th Asia lower boundary is the stop. If you recognize that April 19th Asia is half compressed inside April 16th US midpoint, the deeper structural stop is April 16th US session lower boundary. That stop gives price room to breathe inside the larger box. It reduces the chance of getting removed by noise. The risk-reward changes. The number becomes less attractive, but the trade survives better. That is the real decision. Better ratio or better survival. Most traders choose the prettier number. The market does not care. Price pulls back. It tests the inside area. It does not break the deeper memory. Then it lifts again. Distance increases. Reaction slows. The trade begins to work. Now price reaches April 16th US upper boundary again. It hesitates. Then it pushes higher. It reaches April 14th US session upper boundary. That is the target. You do not hold just because the move still looks strong. You take the level that the structure gave you. If price reaches April 14th U.S. upper boundary and cannot stay above, profit disappears quickly. The move already traveled from compression to upper memory. The trade did its job, so you exit. Not because the market is finished, not because reversal is certain. You exit because the planned structure has completed. Entry came from the midpoint. Stop came from failure below the box. Target came from the next session boundary. That is the method. You are not buying strength. You are buying the place where price fails to break down. You are not placing a stop because you are afraid. You are placing it where the holding attempt dies. You are not taking profit because you feel satisfied. You are taking it where the next memory can stop the move. Price moves up. It reaches. It reacts. And once it reaches the April 14th U.S. upper boundary, the long no longer needs to prove anything. The trade ends there. Price breaks higher, but it cannot keep control. The session forms inside compressed memory. April 20th U.S. session forms at the midpoint of April 14th U.S. session box. It does not form above open space. It forms inside a prior decision area. The session compresses there. Candles stay close. Distance stays short. Price tries to lift. But the move does not open wide. April 20th U.S. session is sitting inside April 14th U.S. midpoint pressure. That location matters. When a U.S. session forms inside another U.S. session midpoint, the market is not free. It is trapped between memory above and memory below. The first reaction looks controlled, but control does not mean strength. Price tries to move up. It approaches April 17th U.S. session lower boundary. It breaks above it. That looks bullish at first. But the break does not run. It tries to reach April 17th U.S. session midpoint. It cannot finish cleanly. The candles begin to stall. Distance becomes shorter. Pullbacks begin to deepen. That is the first warning. If price truly accepts above April 17th U.S. lower boundary, it should move toward the midpoint with cleaner distance. But here, the move struggles. It touches upward. It slows. It returns. You feel the pressure. The breakout is visible, but continuation is weak. That difference matters. A breakout can happen without acceptance. A candle can cross a line and still fail. So the trade is not long. The trade forms from failed continuation. April 20th U.S. session gives the short setup. Short entry line. April 20th U.S. session lower boundary. Stop loss line. April 19th Asia session upper boundary. Take profit line. April 17th U.S. session lower boundary. Risk-reward ratio 3.61. Now the logic becomes practical. Why short at April 20th U.S. session lower boundary? Because price tries to move up from the April 20th U.S. structure. It breaks the April 17th U.S. lower boundary. It tries to reach higher, but the move stalls. When price returns back toward the April 20th U.S. lower boundary, the question changes. Can price hold above the session box, or does it fall back into weakness? If price cannot stay above the April 20th U.S. lower boundary, the breakout has lost control. The lower boundary becomes the trigger. Not because the line is magic, because price already failed to continue higher. The short comes after the failure. You do not short the first red candle. You wait for price to return to the place where the session started losing control. It reaches the April 20th U.S. lower boundary. It cannot hold above. It starts to move down again. That is the entry. The stop sits at April 19th Asia session upper boundary. Why not closer? Because April 20th U.S. session formed inside the midpoint of April 14th U.S. session. The area is compressed. Small reactions can travel back inside. A tight stop can get touched without true invalidation. April 19th Asia upper boundary is the better line because it sits above the recent session memory that produced the previous long expansion. If price climbs back there, the short failure is no longer clean. The market has returned into the upper memory. The short no longer has control. That is where you leave. Not because the loss feels large, because the structure has changed. The target sits at April 17th U.S. session lower boundary. Why there? Because price already broke above it, then failed to continue toward the midpoint. When a break fails, price often returns to the boundary, where the break began. The April 17th U.S. lower boundary becomes the return target. You are not asking for a collapse. You are asking for the failed break to give back its move. That is enough. Risk-reward ratio, 3.61. Good ratio. Clear invalidation. Clear return target. Now watch the pressure. Price moves down from the entry. At first it feels slow. It does not immediately collapse. That can make you doubt the trade. But the key is not speed alone. The key is whether price can reclaim the April 20th U.S. lower boundary. It tries. It stalls. It pushes slightly. It cannot continue. Reaction comes faster. Distance becomes shorter. That keeps the short alive. If price moves back above the April 20th U.S. lower boundary and holds there, the short weakens. If price reaches the April 19th Asia upper boundary, the short is invalid. Until then, you stay with the structure. Price drops again. It reaches toward April 17th U.S. lower boundary. Now the target comes closer. This is where traders make another mistake. They see the move working and want more. But the original target was not random. April 17th U.S. lower boundary is the place where price first broke upward. If price returns there, the failed break has already paid. Holding for more turns. A completed trade into hope. That changes the method. You take the target. You let the structure complete. If price breaks below later, that becomes a new trade. Not the same trade. The short ends at April 17th U.S. lower boundary. Now the full sequence is visible. April 19th Asia session forms inside April 16th U.S. midpoint and overlaps April 15th U.S. box. It holds. It moves up. It targets April 14th U.S. upper boundary. Then April 20th U.S. session forms inside April 14th U.S. midpoint. It tries to break higher. It cannot complete. It returns toward April 17th U.S. lower boundary. The market gives both trades. Long first, short later. Not because direction changed randomly, because behavior changed at the boundary. On April 19th, price held the midpoint and refused to break down. On April 20th, price broke upward and failed to keep control. Same market, different behavior. That is the difference. You are not chasing candles. You are waiting for price to prove where it cannot stay. If it cannot stay below the April 19th Asia midpoint, the long begins. If it cannot stay above the April 20th U.S. lower boundary, the short begins. If it reaches the stop line, the structure failed. If it reaches the target line, the structure completed. Nothing needs to be guessed. The chart keeps testing memory. You react only when the test fails. Price reaches. It cannot stay. It returns. That is the trade. And after April 20th, the question stays open. If the next session forms inside the same memory again, the range can trap both sides again. If reaction comes faster, continuation fails earlier. If distance becomes shorter, movement stays inside. The trade ends. But the structure does not. Price drops first, but it cannot stay down. The session forms at the lower memory. April 20th Asia session forms at the lower boundary of April 17th US session box. It forms inside pressure. It does not start from open space. The first move goes down. It reaches April 20th US session upper boundary. It touches. It slows. The drop should continue, but it does not. Sellers push. Price reacts back faster. Distance becomes shorter. That first reaction matters. The market is not giving clean downside. It reaches the line. It cannot stay below. It returns again. You do not buy the first bounce. You wait. You need failure. Price tests lower again. It reaches April 20th US session upper boundary again. It tries to press below. It cannot stay. Now the pressure changes. Downside touched the boundary. Downside failed to hold. The boundary starts working against sellers. Price lifts. It does not explode yet. It moves slowly. It checks the same level again. That is where the long begins to form. April 20th Asia session gives the long setup. Long entry line. April 20th US session upper boundary. Stop loss line. April 20th US session midpoint. Take profit line. April 17th US session midpoint. Risk-reward ratio 4.67. The entry comes from failed downside. Price reaches April 20th US session upper boundary. It cannot stay below. It returns above. That return is the trade. Not the green candle, not the speed, not the feeling. The reason is simple. Price tried to go lower. It failed. It came back above the boundary. You enter where sellers lose control. The stop sits at April 20th US session midpoint. Price must protect the upper boundary. If it cannot protect it, the long weakens. If price returns to the midpoint, the failed downside no longer holds cleanly. The long is damaged. The midpoint becomes the line. Not because it is close, because the trade depends on the upper half holding. If price drops back into the middle, buyers lose pressure. If price stays above, the long survives. The target sits at April 17th US session midpoint. April 20th Asia session formed at April 17th US session lower boundary. Price dropped first. Then it reclaimed. If the reclaim works, the next real test is higher. That test is April 17th US session midpoint. So the target goes there. The target is not hope. It is the next boundary. Price moves up. It does not move cleanly. It lifts. It stalls. It pulls back. You are in, but the trade feels heavy. That matters. A good trade does not always feel easy. Price keeps returning toward April 20th US session upper boundary. Each return tests your patience. Each pullback asks the same question. Can price hold above the boundary? Can price protect the midpoint? Can buyers move away? price holds. It moves higher. It breaks above April 17th U.S. session lower boundary. Now the long has moved from April 20th memory into April 17th memory, but the move is still not free. Candles start to shorten. Pullbacks come earlier. Distance becomes smaller. That tells you not to expect too much. You are not here to predict a trend. You are here to complete the structure. Price reaches April 17th U.S. session midpoint. It tests. It hesitates. The long target is paid. You exit. You do not hold for more. You do not ask the market to give something it did not promise. The plan was clear. Entry came from April 20th U.S. session upper boundary. Stop came from April 20th U.S. session midpoint. Target came from April 17th U.S. session midpoint. Risk-reward ratio was 4.67. The trade is complete. Now the same place changes. April 17th U.S. session midpoint was the long target. Now price must prove continuation. It reaches the midpoint. It cannot stay strong above it. The move slows. Reaction comes faster. Distance becomes shorter. The level that paid the long now starts blocking the move. That creates the short. Short entry line. April 17th U.S. session midpoint. Stop loss line. April 17th U.S. session upper boundary. Take profit line. April 20th U.S. session upper boundary. Risk-reward ratio 1.88. The short does not start because price is high. It starts because price reaches April 17th U.S. session midpoint and fails to continue. The long completed there. Then buyers lost distance. The market stopped moving away. That failure opens the short. The stop sits at April 17th U.S. session upper boundary. If price reaches that line, midpoint failure is gone. The upside has expanded. The short no longer has control. You leave. The target sits at April 20th U.S. session upper boundary. That was the earlier long entry. When the move up fails, at April 17th U.S. session midpoint, price can return to the boundary that launched it. So the short does not need collapse. It only needs return. Price moves down. It pauses. It tries to lift. It cannot reclaim the midpoint. The reaction comes faster. The distance stays shorter. The short survives. You are watching behavior, not direction. Price moved up. Then it failed. Price dropped. Then it returned. The trade appears only when holding fails. April 20th Asia session gave both sides. Long first. Short next. Same chart. Different behavior. The long starts when price cannot stay below April 20th U.S. session upper boundary. The short starts when price cannot stay above April 17th U.S. session midpoint. Entry follows failure. Stop follows invalidation. Target follows memory. Nothing else is needed. If price holds, you stay. If price fails, you react. If price reaches the target, you take it. The session does not give comfort. It gives pressure. You are inside it. You see the move. You feel the stall. You wait for the boundary. Then the trade decides. Price moves up again, but it cannot keep control. The session forms inside the prior range. April 21st U.S. session forms almost directly across the upper and lower boundaries of April 20th Asia session box. The overlap is clear. The new session does not break away. It sits inside old structure. That matters. Price is not escaping. Price is repeating the same fight. April 21st U.S. session forms inside April 20th Asia session memory. The range is still alive. Price first moves down. It reaches April 20th U.S. session upper boundary. It tests. It reacts. It cannot continue cleanly lower. Then price lifts. It reaches April 21st U.S. session lower boundary. It tests. It cannot stay strong above it. Both sides fail. Downside fails first. Upside fails next. The market rotates. But the bigger short started earlier. April 20th U.S. session formed at the midpoint of April 14th U.S. session box. It compressed there. Then price broke above April 17th U.S. session lower boundary. It tried to reach April 17th U.S. session midpoint. It could not complete cleanly. The move up stalled. Distance became shorter. Pullbacks deepened. That failed upward attempt creates the short. April 20th U.S. session gives the main short setup. Short entry line. April 20th U.S. session lower boundary. Stop loss line. April 19th Asia session upper boundary. Take profit line. April 17th U.S. session lower boundary. Risk-reward ratio 3.61. The entry at April 20th U.S. session lower boundary comes after failed continuation. Price tries to stay above the session. It cannot. It returns toward the lower boundary. Now the line decides. Price holds above it. No short. Price loses it. Short starts. You do not enter in the middle. You do not chase the red candle. You wait for the lower boundary. The lower boundary is where the session either survives or fails. Price reaches it. It cannot hold above. It starts moving down. That is the entry. The stop sits at April 19th Asia session upper boundary. That stop is not random. April 19th Asia session created the previous upward memory. If price climbs back there, the short loses control. The market returns into upper memory. The failed break no longer controls the chart. So the trade ends there. The target sits at April 17th U.S. session lower boundary. Price already broke above that line. Then it failed to continue. When a break fails, price often returns to the line that started it. That return is enough. You are not asking for a crash. You are asking for the failed break to pay back its move. Risk-reward ratio 3.61. Price begins to drop. It does not fall in a straight line. It moves. It stalls. It reacts. Pullbacks deepen. That creates doubt. You feel it. Profit appears. Then price pushes back. The trade feels unstable. But the question stays simple. Can price reclaim April 20th U.S. session lower boundary? Can price reach April 19th Asia session upper boundary? If not, the short remains alive. Price tries to recover. It fails. Price moves down again. It reaches April 17th U.S. session lower boundary. The first target is paid. Risk-reward ratio 3.61 is complete. Now you decide. Take the trade. Or trail it. Trailing does not start early. Price must move away first. The trade must earn protection. After the first target is reached, trailing can begin. First trailing stop line. April 17th U.S. session lower boundary. First trailing target line. April 17th U.S. session upper boundary. Risk-reward ratio 7.74. Price already reached April 17th U.S. session lower boundary. The first return is complete. Now the trade must protect profit. Price comes back. It reclaims the lower boundary. The downside return ends, so the stop moves there. No hope. No wide stop. No giving it back. Price must continue, or the trade ends. The target shifts to April 17th U.S. session upper boundary. The trade is no longer only the original failed break. Now it is managing movement. Inside April 17th U.S. memory, price moves. It stalls. It tries to continue. Reaction speeds up. Distance becomes shorter. You do not widen the stop. You do not negotiate. The trail line decides. Price stays below the trail. The short survives. Price reclaims the trail. The short ends. Then the second trailing stage appears. Second trailing stop line. April 17th U.S. session upper boundary. Second trailing target line. February 3rd U.S. session upper boundary. Risk-reward ratio 10.68. Price has moved far enough. The first structure is complete. April 17th U.S. session upper boundary becomes the control line. Price returns above it. The extension fails. The short ends. Price stays below it. The short survives. Target moves to February 3rd U.S. session upper boundary. Not because you want more. Because price already moved away. Because the trade earned the trail. Because older memory now becomes the next level. The second trail needs proof. No proof. No second trail. No movement away. No extended target. No failed reclaim. No reason to stay. Now return to April 21st U.S. session. April 21st U.S. session forms almost on April 20th Asia session boundaries. It drops to April 20th U.S. session upper boundary. Then it lifts to April 21st U.S. session lower boundary. It does not escape. That matters for management. If you are still in the short, you do not panic on every green candle. You watch the trail. Price reaches the trail. It holds above. The short ends. Price fails below it. The short survives. The stop line decides. The target line decides. Emotion does not decide. April 21st U.S. session keeps rotating. It tests lower. It returns. It tests higher. It fails. This is why trailing is needed. Without trailing, you either exit too early or give back too much. With trailing, the market must prove more. The trade has already paid. Now price must earn the next stage. Original short. Entry at April 20th U.S. session lower boundary. Stop at April 19th Asia session upper boundary. Target at April 17th U.S. session lower boundary. Risk-reward ratio 3.61. First trail. Stop at April 17th U.S. session lower boundary. Target at April 17th U.S. session upper boundary. Risk-reward ratio 7.74. Second trail. Stop at April 17th U.S. session upper boundary. Target at February 3rd U.S. session upper boundary. Risk-reward ratio 10.68. Each stage has a job. The original trade captures failed breakout. The first trail protects the return. The second trail presses extended movement. You do not mix them. You do not trail before price moves. You do not hold after the trail fails. You do not expand the target without proof. That is the method. Entry comes from failed holding. Stop comes from structural invalidation. Target comes from the next memory. Trail comes from earned distance. April 20th Asia session showed how failed downside can become a long. April 17th midpoint showed how failed upside can become a short. April 20th U.S. session showed how failed breakout can become a larger short. April 21st U.S. session showed why management matters. The market keeps moving, but it cannot stay clean. It drops. It returns. It lifts. It fails. The answer is not direction. The answer is behavior at the boundary. If price cannot stay below April 20th U.S. session upper boundary, the long can form. If price cannot stay above April 17th U.S. session midpoint, the short can form. If price cannot reclaim April 17th U.S. session lower boundary, the trailing short survives. If price returns through the trail, the trade ends. No prediction, no chase, only tested structure. The move ends here. The next question remains: can price stay outside memory, or does it return again? Price moves up, but it cannot stay. The session forms inside previous memory. April 21st Asia session forms at the lower boundary of April 21st U.S. session box. It stays there. It compresses. Price pushes up. It reaches the boundary. It pauses. It should continue, but it does not. It stays too long. That delay matters. If price is strong, it leaves immediately. Here, it waits. It pushes again. Same level. Same hesitation. Distance is short. Reaction comes faster. Nothing expands. Everything overlaps. This is not breakout. This is friction. You see movement, but you feel no progress. Price finally breaks above April 21st U.S. session upper boundary. It looks clean. It looks fast. But right after, something changes. The next candle is smaller, then smaller again. Then it stalls. Momentum does not build. It fades immediately. Pullbacks start earlier. Reactions come faster. Distance compresses. This is not strength. This is depletion. Price reaches April 17th U.S. session midpoint. Selling stops. But buying does not take over. It holds, but cannot move away. You are watching it. It should expand here. But it does nothing. Time passes. Position is still open, but nothing moves. This is pressure, not loss, but uncertainty. Price is not rejecting, but also not continuing. It stays. It lingers. It drains your conviction. Then it pushes again. Reaches April 17th U.S. session upper boundary. Touch. Pause. Fail. Distance is shorter now. Reaction is faster now. Each attempt weakens. You start to see it. This is not building strength. This is losing it. Then, final push. Price reaches February 4th U.S. session upper boundary. Same as February 2nd U.S. session midpoint. This is the decision zone. You expect expansion, but price freezes. No follow-through. No aggression. Just hesitation. It touches. Stops. Waits. Buying comes, but cannot travel far. Selling comes, but cannot push down fully. Everything compresses at the top. You feel it now. The chart is moving, but the trade is not progressing. This is where most hesitate, because it still looks bullish, but it no longer behaves bullish. Now execution forms. April 21st Asia session. Price reaches February 2nd U.S. session midpoint. It does not reject instantly. It tries to stay. That attempt to stay is the only reason to act. Long at February 2nd U.S. session midpoint. Because price reached the level and was not pushed out. Stop sits below February 2nd U.S. session lower boundary. Because if price reaches there, this holding attempt is gone. No holding, no structure, no trade. Target sits at February 2nd U.S. session box 1.5x extension. Risk-reward ratio 2.03. Price moves up, but slowly. Each push takes effort. Each continuation fails earlier. You are in profit, but it feels unstable. The chart moves, but distance does not increase. This is the trap. You are winning, but nothing confirms it. Then reaction hits. Downside moves faster than any upside before. That is the shift. If downside reacts faster, upside is already broken. Price returns toward entry. It should bounce, but it hesitates. It lifts slightly, then stalls again. You feel it now. Holding is no longer safe. The structure did not break, but it also did not continue. That is enough. Then it drops. Fast, clean, decisive. And now it is obvious. The move up was never expansion. It was slow failure. Price drops, but it cannot continue. The session forms inside upper memory. April 22nd U.S. session forms inside the mid-upper range of February 2nd U.S. session box. It compresses. It holds. Then sudden push-up. Price reaches February 2nd U.S. session box 1.5x extension and instantly fails. No pause. No test. Immediate rejection. This is different. Before, price hesitated. Now, it fails immediately. That speed matters. Price returns inside, then tries again. Same level, same failure, but faster. Distance shorter. Reaction quicker. You do not need explanation. This is not breaking. Now execution forms. April 22nd U.S. session. Short at February 2nd U.S. session box 1.5x extension. Because price reached twice, failed twice, and failed faster. Stop sits above February 2nd U.S. session box 2x extension. Because if price reaches there, this failure sequence is gone. Target sits at April 22nd U.S. session box lower boundary. Risk-reward ratio 1.82. Price drops. Strong at first, then weaker, then stalls. Continuation fades again. Pullbacks interrupt. Distance shrinks. You are in profit, but it does not feel clean. Moves overlap. Reactions increase. This is compression, not trend. If downside is strong, it continues. Here, it hesitates. So you adjust. Trailing begins. Stop moves to April 22nd U.S. session box midpoint. Because if price returns there, downside has failed. Target extends deeper. To February 2nd U.S. session box lower boundary. Risk-reward ratio 2.95. Price drops again, but not clean. Moves. Stops. Moves again. Each move shorter. Each reaction faster. You feel it. The market is not trending. It is tightening. Both sides fail. Upside fails instantly. Downside fails slowly. Everything returns. This is the trap. Strong moves appear, but none survive. Every breakout becomes return. Every attempt fails faster. You are not trading direction. You are trading where price cannot stay. If it cannot stay above February 2nd U.S. session midpoint, it returns. If it cannot stay above 1.5x extension, it collapses faster. If it cannot break below session low, it rotates again. Entry is not prediction. Stop is not protection. Target is not expectation. Everything comes from one thing. Can price stay or not? And across April 21st and April 22nd, it never could. Price moves down, but it does not accelerate. The session forms inside previous pressure. April 22nd Asia session forms near the midpoint of April 21st U.S. session box. It stays there. It compresses. It does not expand. Price tries to lift. Distance is short. It gets pushed back quickly. You see it. Up moves are weak. Down moves come faster. This is not balance. This is pressure building. Then the price drops. It breaks below April 22nd U.S. session lower boundary. No hesitation. No pause. That matters. If price leaves a boundary cleanly, it does not come back immediately. Here, it continues. Price drops again. Breaks below February 2nd U.S. session lower boundary. Still no hesitation. Distance increases. Pullbacks are shallow. This is continuation. But even here, you check again. Does it slow? Does it hesitate? Not yet. Price continues. Reaches April 17th U.S. session upper boundary. Now it pauses. This is where structure meets structure. It touches. It stops. It compresses. You feel the shift. Downside was clean. Now it hesitates. This is where execution matters. First, this is not a new trade. April 22nd U.S. session already formed a short entry at February 2nd U.S. session 1.5x extension. That position is still active. So this move down is not entry. It is exit. April 22nd Asia session is where that short gets closed because price reached April 17th U.S. session upper boundary. It paused. It compressed. Downside no longer accelerates. That is enough. You exit, not because reversal is confirmed, but because continuation stopped. Now assume you did not have that short. Now you must decide again. April 22nd Asia session. Price already broke. April 22nd U.S. session lower boundary. It returned slightly. It hesitated. This is where most fail, because they try to chase. But structure is already extended. You do not chase extension. You wait for return. Price comes back to April 22nd Asia session box lower boundary. It touches. It pauses. It tries to move up. But distance is short. It cannot stay above. This is the signal. Short at April 22nd Asia session lower boundary, because price returned to boundary and failed to hold above it. Stop sits above April 22nd Asia session upper boundary, because if price moves there, this failure has turned into acceptance. Target sits at February 2nd U.S. session lower boundary, because that is where price already broke and where continuation completes. Risk-reward ratio 2.85. Now the critical mistake. Some place stop at midpoint. April 22nd Asia session midpoint. That feels logical. But look at structure. The box is compressed. Midpoint is too close. Too thin. Price does not need to reverse to hit that level. It only needs noise. Small pullback, normal fluctuation, and you are out. Even if direction is correct. This is the trap. You are right, but positioned wrong, because your stop does not represent failure. It represents discomfort. So rule becomes clear. If session is compressed, midpoint is not a boundary. It is noise. You avoid it. You use full boundary. Only there does structure actually fail. Price moves down. At first, clean. Then slower. Then stalls. Distance reduces. Reactions increase. You feel it again. Continuation is ending. And that is enough. Price moves up, but it cannot stay. The session forms inside lower memory. April 23rd U.S. session forms. Inside the lower half of February 2nd U.S. session box. It compresses there. It holds. Then price lifts. It breaks above April 22nd U.S. session lower boundary. It continues. Reaches April 22nd U.S. session midpoint. Then stops. This is the decision. If price is strong, it continues above midpoint. But it does not. It pauses. It compresses. Distance shrinks. Then it drops. Back inside April 23rd U.S. session box. That matters. Because breakout failed. Now execution forms. First scenario. Long at February 2nd U.S. session lower boundary. Because price reached the level. It held. It moved away. Stop sits below April 17th U.S. session upper boundary. Because if price reaches there, this holding has failed. Target sits at April 22nd U.S. session midpoint. Because that is where price already failed once. Risk-reward ratio, 3.8. Price moves up. It reaches target zone, then slows. This is where most hold. But structure already told you. Midpoint is resistance, not continuation. So you exit, not at top, but at failure zone. Second scenario. Price reaches April 22nd U.S. session lower boundary again. But now from below, it touches. It pauses. It tries to go above, but cannot stay. This is the shift. Same level, different behavior. Before, it broke above. Now, it cannot hold above. That is enough. Short at April 22nd U.S. session lower boundary. Because price failed to stay above it. Stop sits above April 22nd U.S. session upper boundary. Because if price moves there, this failure becomes expansion. Target sits at April 17th U.S. session upper boundary. Because that is where downside previously paused. Risk-reward ratio, 1.52. Price drops, but not clean. Moves stall. Reactions increase. You feel it. This is not strong trend. This is rotation. If downside was strong, it would accelerate. Here, it hesitates. So you manage. You do not expect extension. You expect return. Now everything becomes clear. April 22nd showed clean failure and continuation. April 23rd shows mixed structure. Both sides fail. Nothing holds. That is the environment. You are not predicting direction. You are watching behavior. If price cannot stay above April 22nd U.S. midpoint, it returns. If price cannot stay below February 2nd lower boundary, it returns. If both fail, you reduce expectation. Entry is not guess. Stop is not fear. Target is not hope. Everything comes from one question. Can price stay or not? And across April 22nd and April 23rd, it keeps failing to stay. Price moves up, but it cannot stay. The session forms at the boundary of previous memory. April 23rd Asia session forms near the lower boundary of April 22nd U.S. session box. Price pushes up. It reaches April 22nd U.S. session midpoint. It pauses. It should continue, but it does not. Buying stops early. Distance is short. Reactions come faster. This is the first signal. If price is strong, it leaves midpoint immediately. Here, it cannot. Then it drops. It breaks below April 23rd U.S. session upper boundary. No hesitation. No return. That matters. Because when price leaves a level cleanly, it shows acceptance below. Price continues down. Reaches April 23rd U.S. session lower boundary. Now it pauses. Downside slows. Distance shrinks. Pullbacks deepen. This is the second signal. Continuation is weakening, but not reversing, just losing speed. Then price moves back up. Returns inside April 23rd Asia session box. You feel it now. Nothing holds. Up failed earlier. Down now slows. This is rotation. This is where execution forms. First setup. Price returns to April 23rd Asia session upper boundary. It touches. It tries to move above, but cannot stay. Distance is short. Reaction is fast. This is not breakout. This is failure to hold. Short at April 23rd Asia session upper boundary, because price reached the level and failed to stay above. Stop sits at April 22nd U.S. session upper boundary, because if price reaches there, this failure becomes expansion, not noise, not hesitation, actual structure break. Target sits at April 23rd U.S. session lower boundary, because that is where price already showed slowdown and hesitation. That is where rotation completes. Risk-reward ratio 1.88. Price drops. At first, clean, then slower, then stalls. Distance reduces. Reactions increase. You are in profit, but nothing extends. This is the pressure. You expect continuation, but the chart refuses. This is where most hold too long, because direction looks right, but behavior is wrong. Second setup. Price reaches April 23rd U.S. session lower boundary. It touches. It holds. This is different. Before, levels failed quickly. Now, price stays. It does not get pushed out. This is the signal. Long at April 23rd U.S. session lower boundary, because price reached and was not rejected. Stop sits at February 4th U.S. session lower boundary, because if price reaches there, this holding attempt is gone. No holding. No structure. No trade. Target sits at April 23rd Asia session lower boundary, because that is where price previously returned inside. Risk-reward ratio 2.32. Now the key decision. Stop placement. Some place stop closer. At April 23rd U.S. session box lower extension, or midpoint. That improves reward. But look at the candle. April 23rd U.S. session, 1300 candle. The wick is long. That means price can move aggressively without breaking structure. If your stop sits too close, you are not protecting structure. You are protecting comfort. So you move stop deeper to February 4th U.S. session lower boundary, because only there Does structure actually fail? Price moves up. Slowly. With hesitation. But it holds. That is enough. Not strong, but stable. That is all you need. Price moves again, but cannot escape. The session forms inside previous structure. April 24th U.S. session forms completely inside. April 23rd Asia session box. Full overlap. No expansion. No separation. Everything stays inside. This is not trend. This is compression. Price moves down. Reaches April 23rd U.S. session lower boundary. It pauses. It should break, but it does not. Distance is short. Reaction comes faster. It returns slightly. You see it clearly. Downside is not clean. Upside is not strong. Both sides hesitate. This is containment. Now price moves up again. It reaches April 23rd Asia session upper boundary. Same level as before. It touches. It tries to move above, but cannot stay. Distance is short. Reaction is fast. This is the same behavior. Same failure. So the setup appears again. Short at April 23rd Asia session upper boundary. Stop at April 22nd U.S. session upper boundary. Target at April 23rd U.S. session lower boundary. Risk-reward ratio 1.88. Everything looks identical. Same level. Same reaction. Same structure. So most traders take it. But this is where the mistake happens. This time is different. Because this is not just interaction. This is April 24th U.S. session itself. The session is forming at this level. That changes everything. Before, April 23rd Asia session was reacting to an already defined structure. Now, April 24th U.S. session is defining the structure. That means this is origin, not reaction. If you short here, you are not trading a failure inside structure. You are trading inside formation. That means probability drops, not because level is wrong, but because structure is not finished. Price can move both ways. It can fail, or it can expand. And both are valid. Look at behavior again. Price reaches the level, fails, returns, but does not accelerate. It stalls. It overlaps. That hesitation is not confirmation. That hesitation is uncertainty. If failure was strong, price would drop immediately. But here, it hesitates before moving. That delay matters. This is where you decide. Option 1. You take the trade, but you reduce size because environment is unstable. You are not trading a clean failure. You are trading a forming structure. Option 2. You skip the trade because even though setup looks identical, context is different. This is the key difference between execution and imitation. Same setup does not mean same trade. Now look deeper. Price drops, but not clean. Moves, stops, moves again. Each move shorter, each reaction faster. This is compression. Inside expansion attempt. You feel it. There is no commitment. No direction holds. Everything returns. If you took the short, you feel pressure immediately because it does not move away. It stalls. It gives nothing. This is the signal. Not loss, but lack of confirmation. If price cannot move away from entry, it is not strong. This is why this trade is optional. Not because setup is wrong, but because environment is not clean. Now the lesson becomes clear. April 23rd Asia session. Structure defined. Reaction confirmed. Trade valid. April 24th US session. Structure forming. Reaction unclear. Trade optional. This is the difference. You are not trading levels. You are trading when levels matter. Entry is not the edge. Context is. Stop is not protection. It is confirmation of failure. Target is not expectation. It is where structure completes. So before every trade, you ask one question. Is this level being tested or being created? Because if it is being created, you are early, and early means uncertain. And across April 24th US session, price is not reacting. It is still forming. The 1-hour chart moved first. Now the larger time frames answer. The daily chart shows the path. The weekly chart shows the trap. The monthly chart shows the pressure. This part connects them. The 5 daily sessions already showed the fight. Price moved up. It failed. Price dropped. It extended. Then it returned. Session memory kept pulling price back. Now the question changes. Why did the 1-hour chart keep reacting like that? Why did the moves look strong but fail? Why did some entries work only at the boundary? Why did late entries lose space so fast? The answer does not come from the 1-hour chart alone. It comes from the higher structure. Daily first. The daily chart shows where this week entered late space. It shows the 120 simple moving average. It shows the 0.5 area. It shows the February 1st daily box upper boundary. Those levels sit close. Price approaches them. The space becomes narrow. You cannot chase there. If price enters late near that zone, the stop becomes wide. The target becomes short. The trade becomes uncomfortable. That is why the 1-hour chart felt unstable near the top. Weekly next. The weekly chart shows repeated compression. February 1st week forms inside January memory. March 1st week forms inside February memory. April 1st week forms inside March memory. Each new box gets trapped inside old structure. The week moves. But the larger structure keeps holding it. That is why the 1-hour chart keeps giving failed continuation. Monthly last. The monthly chart gives the biggest warning. April is not complete. The candle still moves. It can still change. But it already checks the March upper wick. It overlaps the February drop. It moves toward the lower boundary of the 2026 first monthly box. That looks like recovery. But recovery is not freedom. Price must stay. If it cannot stay, it returns. So the higher time frame does not tell you to buy blindly. It tells you to trade more carefully. Next week, the plan does not come from opinion. It comes from location. If price reaches resistance and stalls, do not chase. If price pulls back and holds a boundary, wait for reaction. If price fails above the daily 0.5 zone, shorts can form again. If price holds above it and distance expands, longs can continue. But every trade must pass the same test. Price reaches. It reacts. It holds or fails. Then you act. Now we start with the daily chart. Price climbs, but space gets smaller. The daily session forms inside higher pressure. April 1st daily candle forms around the midpoint of March 1st daily candle box. It compresses there. It overlaps there. It does not start from open space. It forms inside March memory. Then price moves up. It breaks above March 1st daily candle box upper boundary. It does not stop there. It pushes again. It breaks above February 1st daily candle box, lower boundary. Now the move looks strong. But the next level is close. Price reaches toward February 1st daily candle box upper boundary. That level sits near the 0.5 area. The March 1st daily candle box lower boundary sits near the 0.33 area. So the daily move travels from the 0.33 memory toward the 0.5 memory. It moves. But the distance is not free. Each higher level gets closer. Each reaction matters more. The upper Bollinger Band and lower Bollinger Band are contracting. The range narrows. The move still rises. But expansion is not clean. A narrowing band changes the trade. You do not chase late. You wait for a boundary. Price approaches the 120 simple moving average. Price approaches the 0.5 area. Price approaches the February 1st daily candle box upper boundary. They sit together. That cluster demands caution. If price reaches that area and cannot stay above it, the move can return fast. If price holds there and moves away, the next continuation can form. But before that happens, late longs become dangerous. You can see why the 1-hour chart behaved that way. During the week, price moved upward. It broke session boundaries. It reached targets. Then moves stalled. The daily chart explains the stall. The 1-hour chart was not weak by accident. It was moving into daily pressure. That is why entry location mattered. If you entered early at session memory, you had space. If you entered late near daily resistance, there was almost no space left. That difference decides the trade. The daily chart gives a simple execution rule. When price moves from March 1st daily midpoint toward February 1st daily upper boundary, do not chase the middle of the move. Wait for pullback. Wait for holding. Wait for failure. If price holds above February 1st daily lower boundary, long setups can continue. If price reaches February 1st daily upper boundary and fails, short setups can form. If price sits between them, the 1-hour chart can rotate. This is why the daily chart matters. It does not replace the 1-hour chart. It gives the space around it. The 1-hour chart gives entry. The daily chart gives danger. Now look at the current position. Price is near the 0.5 area. It is near the 120 simple moving average. It is near February 1st daily candle box upper boundary. That is not a place for emotional buying. That is a place for proof. Price must stay. If it cannot stay, it returns. If it returns, the 1-hour chart will show it first. A US session may fail at the upper boundary. An Asia session may form inside the prior box. A midpoint may stop continuation. Then the short setup appears. But if price holds above this daily cluster, the story changes. The 1-hour pullbacks can become entries. The daily resistance can turn into support. The next session can build above it. But that must happen first. You do not assume it. You wait. The daily chart gives the map. April 1st daily candle forms inside March memory. It breaks above March upper boundary. It breaks above February lower boundary. It reaches toward February upper boundary. The Bollinger Bands contract. The 120 simple moving average sits near the 0.5 area. The next trade needs patience. Now ask the real question. Does the week look clearer? The 1-hour chart kept failing near the top. Now the reason is visible. Price was climbing into daily resistance. So next week, the plan is not to chase strength. The plan is to test holding. Price reaches the daily cluster. It holds. Then longs conform. Price reaches the daily cluster. It fails. Then shorts conform. Same chart, different behavior. Price lifts. But the weekly structure still traps it. The weekly candle forms between old boundaries. This week sits exactly between March 1st weekly candle box upper boundary and February 1st weekly candle box upper boundary. It does not sit in empty space. It sits between two memories. That matters. April 1st weekly candle forms inside March 1st weekly candle box. March 1st weekly candle forms inside February 1st weekly candle box. The boxes keep compressing. February holds March. March holds April. Each month gives a smaller fight. Each week reacts faster. Distance becomes shorter. Continuation fails earlier. That is why the 1-hour chart felt trapped. The weekly chart already had compression. Then the 1-hour chart repeated it. When the higher time frame compresses, intraday breakouts can look strong, but they fail faster. They reach, they stall, they return. Now look at the larger position. February 1st weekly candle, March 1st weekly candle, and April 1st weekly candle all form below January 1st weekly candle box. That is important. Price is rising, but it is still below January memory. So the move can look like recovery, but it is still under a larger ceiling. You cannot treat every green candle as full reversal. You need acceptance. Price must stay above the weekly box. Price must hold distance. Price must not return inside. If it cannot do that, the move remains trapped. This week also moves between the first descending trend line and the second descending trend line from February. Price moved sideways between them. Then it broke upward. That break matters. But again, a break alone is not enough. Price must stay outside. If it breaks above the trend line and returns immediately, the breakout fails. If it holds outside and pullbacks become shallow, the move survives. On the weekly chart, the Bollinger Bands are expanding. That changes pressure. The market has room to move, but room is not direction. Expansion allows distance. It does not guarantee continuation. That is why the weekly chart must be paired with the daily cluster. Weekly shows the breakout attempt. Daily shows the resistance cluster. One says movement can expand. The other says price is approaching pressure. That conflict explains next week. If price holds above the daily 0.5 area, the weekly breakout can continue. If price fails there, the weekly breakout can return inside. Then the 1-hour chart becomes dangerous again. Breakouts can fail. Session boxes can rotate. Targets can be reached quickly. Stops must sit beyond structure failure. Now translate this into execution. For next week, do not enter because price already moved up. That is late. Wait for price to return to a weekly related boundary. Wait for a daily support test. Then move to the 1-hour chart. If Asia session forms above the daily cluster and cannot break down, long setups can form. If US session pushes above the cluster and returns inside, short setups can form. If price forms inside the same weekly compression, range trades become more reliable than breakout chasing. The weekly chart tells you which behavior to expect. Compressed weekly structure creates traps. Expanding Bollinger Bands creates speed. Together they create sharp moves that can still fail. That is exactly what the week showed. Price moved, then stalled. Price broke, then returned. Price extended, then failed. The weekly chart does not give comfort. It gives the environment. Now the key weekly question. Can price stay above the compressed February to April structure? Can price hold outside the descending trendline area? Can price push toward January memory without returning? If yes, longs can continue. If no, the move becomes another failed break, and failed breaks become short setups. The weekly chart does not tell you to buy or sell right now. It tells you where execution must be strict. Above the compression, pullbacks can be long entries. Below the compression, failed rallies can be short entries. Inside the compression, targets must be closer, because movement returns faster. The week sits between old boxes. It broke a trend line. It still faces memory. That is the pressure. Next week starts there. Price looks like reversal, but it is not free yet. The monthly candle is still forming. April monthly candle is not complete, so you do not treat it as final, but it already gives pressure. April checks the full upper wick of March monthly candle. It overlaps the falling body of February monthly candle. Price is moving back into the prior drop. That looks strong, but strength must stay. If April cannot hold inside that recovered area, the move can return again. The monthly chart shows the largest trap. You think it is reversing, but it is still testing. Price is moving toward the lower boundary of the 2026 first monthly candle box. That area sits near the 0.5 level. It is not just a line. It is monthly memory. The 2026 first monthly candle box formed, overlapping the lower boundary of the 2025 first monthly candle box. Remember that. The current move is not approaching random resistance. It is approaching a stacked monthly boundary. 2025 first monthly lower boundary, 2026 first monthly lower boundary. The 0.5 area. They sit close. Price moves toward them. That creates pressure. If price reaches that zone and cannot stay above, the monthly recovery weakens. If price reaches that zone and holds above, the larger recovery can continue. But until April closes, nothing is confirmed. The Bollinger lower band is closing. That matters. Downside pressure is no longer expanding the same way. The lower band closes. The drop loses wide space. Price can bounce, but a bounce inside monthly resistance can still fail. So the monthly chart gives caution, not fear. Caution. It tells you not to chase late upside. It tells you not to short blindly either. It tells you to wait for the next session reaction, near the monthly boundary. Now connect this to the week. The 1-hour chart gave many fast moves. Some longs worked, some shorts worked, but every good trade came from a boundary, not from emotion. The daily chart shows price reaching the 120 simple moving average and the 0.5 area. The weekly chart shows price escaping the descending trendline area, but still sitting under larger memory. The monthly chart shows price approaching the 2026 first monthly lower boundary. So next week, you need patience. If price opens near monthly resistance, do not chase the first green candle. Wait. If Asia session forms near the boundary and cannot move away, the range can trap price again. If US session pushes above the boundary but returns quickly, the breakout fails. If price pulls back and holds the daily box, long setups can form again. If price breaks below the daily cluster and cannot reclaim it, short setups can form. The monthly chart gives the biggest condition. Can price stay above the 2026 first monthly lower boundary? If it cannot, the recovery is still incomplete. If it can, the next weekly continuation has room. But you do not decide early. April is still forming. The candle can change. The wick can grow. The body can shrink. The close can shift everything. That is why the 1-hour chart matters next week. The monthly chart gives the zone. The weekly chart gives the pressure. The daily chart gives the active boundary. The 1-hour chart gives the trade. You wait for all of them to connect. Price reaches monthly memory. It stalls. You watch the daily level. Price returns into daily range. You move to the 1-hour chart. Session forms inside. Boundary fails. Short can form. Or price reaches monthly memory. It pulls back. It holds the daily boundary. The next US session forms above it. Long can form. The difference is not opinion. The difference is holding. Everything returns to the same rule. Price reaches. It reacts. It either holds or fails. Then you execute. This week was not random. The 1-hour moves were not random. They were working under daily resistance, weekly compression, and monthly recovery pressure. That is why strong moves kept failing. That is why late entries had no space. That is why stops had to sit beyond structure. That is why targets had to come from session memory. Now the weekly long form closes here, not with prediction, with preparation. Next week, price may continue higher, or it may fail again. Both are possible. So we do not guess. We prepare the lines. Daily 0.5 area. 120 simple moving average. February 1st, daily upper boundary. Weekly compressed boxes. Monthly 2026 first candle lower boundary. Price reaches them. It either stays or returns. That answer creates the next trade.